You know, design and engineering really makes a difference. Like, for example, this is poor engineering. The water from this gutter is flowing out and going right back into the foundation. When you're building your own private banking system, design and engineering matters. You want to make sure that it's designed and engineered for maximum efficiency, unlike this. Come on, let me show you. But you know, there are engineers that design things that work really, really well. Like, look at this. All this is they made one change in the design, and now the water is properly flowing. This is exactly what we do when we build your private banking system. We design and engineer a whole life insurance policy for maximum efficiency, maximum high early cash value, so that you have more money to use and your money can flow the right way. Speaking of flowing, I think it's time for a swim, right? Let's go for a swim. Welcome back, everybody. Another week, another wealth webinar. Today, we're going to do a topic that I think all of you are going to love. And by the way, thank you, every single one of you, for joining us today. I love that you're all giving your most valuable resource to be here today, and that is your time. But these webinars, we've been doing these live every single week, never missing one, for over 7 years, and they've always been free, but nothing in life is free. I think all of you know that, because your time is the most precious, valuable resource you have. So this webinar, although you didn't pay, you are paying because you are investing your time, and your time is being invested to learn something new, something that can change your life, something that will bring value to you and your family, and something that will change your financial future. But most importantly, the main reason many of you are here, I would have to guess, and let me know if I'm wrong in the chat, but I'd have to believe you're here because you want to learn how to be your own banker, right? You want to learn how to take back control of your money. You want to learn how to have your money work for you 24/7, 7 days a week, so that you don't have to trade your time for dollars each and every single day, and then work right up until the day they tell us that we can retire, which is 59 and a half. Most, it takes a lot longer than that. We got to change the way we do things, folks. Okay, the cavalry's not coming to save you. The government's not coming to save your finances. Believe me, it's on you more now than it ever has been. And today, that's what we're going to do. We're going to teach you how to be the bank, but specifically what we're going to go into today is showing you how to design and engineer your private banking system. When we talk about a private banking system, we're talking about, number one, a process, a change in the way you handle your money and the way your money flows. That's the process. They call that the infinite banking concepts, pioneered by the late R. Nelson Nash and his book, Becoming Your Own Banker. How many of you have read Becoming Your Own Banker? Put I in the chat. I bet you a lot of you. And then, how many of you have read Mapping Out the Millionaire Mystery, the book that I wrote with Brent Kessler? Probably a bunch of you as well. Those books lay it out, but they don't. And I'll tell you something, what you're going to learn today, let me pause on what I was just saying. What you're going to learn today, no one else wants you to know this. The other agents in the industry get really ticked off at us for doing these videos. They get really mad at some of my YouTube videos where I take all of you behind the scenes and show you how this is actually done, because I think a lot of people feel like once somebody knows how to design and engineer the policy for their private banking system, they won't need us. But you know what? I believe in an educated client. I believe in helping people solve their problem. And if I help them understand how, the why behind the problem that we're solving and how we're going to do it, then I feel like you, all of you, are far, far better off, and you're a much more educated client. So when we're working with you, you know why we're doing what we're doing. And then we've created software called the Vault, which we'll be showing you today, that allows you to engineer and design your policies specifically for your needs and goals. So no longer is there just one ready-built plan design or policy design that works for everybody. Every single person has their own unique plan design, and I'm going to go into that. Craig is going to show you that. We're going to show you the different plan designs. We're going to show you why we use these different plan designs, and we're also going to show you how these plan designs reduce our compensation. Okay, so in life, you will all realize that to get ahead, you have to give. Always lead with giving. Now, I know that's easy to say, but hard to do. To give your whole life, to be a giving soul your whole life is hard because it's just empty feeling, right? You're constantly giving and giving and giving. And, then you start to think like, why am I going to give anymore? Nobody gives back. You're not trying to get others to give back, folks. It's a universal law. When you give, you get. So in that same context, the way we design and engineer these policies, in many cases, and actually all cases, will reduce our compensation, our commission, by 60 to as much as 90%. You're going to have a hard time finding a financial advisor, a hard time finding a life insurance agent that wants to give up 80 to 90% of their paycheck so that you have more cash value to use immediately in the first 30 days. I mean, it just makes sense, right? You can't just go to your financial advisor and say to him, hey, Mr. Mrs. Advisor, I would like you to make 80 to 90% less so that I have 80 to 90% more, right? That doesn't seem like they're going to be very receptive to that, but that is exactly how this works, folks. There is no magic. There is no hocus pocus. I know they want you to think that this is some miraculous, crazy thing that they can do and nobody else can do, but every advisor and every agent, if they learn, can do what we're going to show you today. But we're just going to show it to you. So that if you don't work with us, which I would hope that if you're looking to set up your own private banking system, you're looking to build your policies for yourself, your children, your family, or your business, maybe even your trust, you would use us. But if you don't, we want you to basically know just what is needed to design these policies. Fair enough? I always like to give a shout out to everybody that's here for the first time because I love that. And because you're all here for the first time, I don't like to just jump right into things because then I miss a lot of context. I miss a lot of things that you would need to understand about what is the infinite banking concepts. Why would you want to use this in your life? Why would you want to build your own private banking system? I mean, these are questions all of you that are here for the first time, maybe like Lance, you're here the second time, you want to really clarify your why. Like, all right, Chris and Stephen and Craig, like, this is great. I heard about this. I saw this ad, but why would I want to do this? Well, that's where I want to start. If it's okay with all of you, before we dive into plan designs, before we design, and engineer a policy, and I break it down from an illustration standpoint, I want to show all of you why this should be changed, okay? So in this process, okay, the infinite banking concept, what we're really trying to do is we're trying to create control of your money. Because right now, what you've been taught and what you've been told to do with your money does not always put you in control of it. If you are putting your money into a bank account and you're hoping you're going to build wealth that way, you are not, because you are not in control of your money. The bank is. The bank is the one going to make the money because the bank's going to lend your money out, make a spread on your money, and make 400 to 1,300% more than you are on your dollars that you deposited in your bank account. And by the way, don't be surprised when you go to your bank and you ask to take out a large withdrawal of money that the bank doesn't ask you why you want to take your money out of your bank account. A lot of yours in there, right? Well, it's not really your money anymore. You see, when you deposit money in the bank, if you read the fine print on that application, you're effectively giving the bank control of your money to do whatever they want. And I prove that. Banks never, ever call you. Chase Bank did not call me this week, this month, or this year to ask if they can lend my money that I leave in their bank out. They just lend it. I give them money, let's call it, I give them 10 grand. They immediately lend 10 grand out. I'm going to pick on Michelle here. They lend that money out to Michelle at like 8% for a car loan. But Michelle, you're paying them 8% on my money. I'm only getting 1% on my money. So who's making the money? The bank is. They're making 7%. They're making an arbitrage. That's how banks make money. And there's many other ways, but that's the fundamentals. So if you can understand that, then what we need to do is turn the tides. We need to put you in the driver's seat, you in the banker's seat. You need to become the bank. You need to be the one making the arbitrage, not the bank. Follow what I'm trying to say? That's the single solitary thing that we're trying to do here. We are trying to teach you how to take back the banking functions in your life. Because let me be clear about something. Your need for finance during your lifetime is greater than anything else. It truly is. And when I say finance, you think I mean you're going to go finance your refrigerator, you're going to finance your car, you're going to finance your house, your rentals, whatever. I mean, you finance everything, because throughout your life, whether you're borrowing money or whether you're using your own money, you are giving up interest. You are either paying interest or you're giving up interest. Both of them are financing. I'll give you a perfect example. A lot of people think that they're doing themselves a favor when they save up money in a bank account to go buy a car cash. They got all the money saved up for the car. They take the money out of the bank account, and let's say they got a high yield savings earning 4%. They take their 50 grand out of the bank account, they plop it down on their shiny brand new BMW that they just bought, and they think they won because they don't have to make a payment to BMW Finance. But you see, they are still making a payment. That's the thing a lot of people miss. You had 50 grand in an account earning 4% interest. When you took the 50 grand out to buy the car, you stopped the earning potential of that $50,000. And we're only talking about 4%. Like, I can't remember who it was on here that said they were an advisor. Like, obviously, you know, we can make more than 4% on our money, but I'm just using 4% because that's a pretty common number that we hear on this webinar for people with high yield savings. So when you take the 50 grand out and you buy the car will depreciate. The second it rolls off the lot, can you sell it for 50 grand? Probably not. It depreciates instantly. And then every mile you put on, every day that goes by, every year that goes by, your car becomes worth less. It's a depreciating asset, not an appreciating asset. Follow me? But the $50,000 you saved no longer works for you and no longer works for your family. So it can't provide a better life for you. That is financing, folks. Whether you believe it in the normal context of financing, it is, because you are giving up the opportunity to earn interest on that money. And then if you lease it or finance the car thinking you're doing yourself a favor, you're still making monthly payments to a finance company, and that monthly payment is a mixture of principal and interest. Whether you like it or not, you're giving up the interest. So if we just could take back those two things, I can promise you every one of you would live a more fulfilled, financially successful life, because your money would not be leaking. You wouldn't be giving away interest. You wouldn't be paying everybody else interest instead of yourself. You need to prioritize yourself, and that single-handedly is why you want to become the bank. But there's a couple things. Today, we're going to specifically focus around a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. I know that's a mouthful. We only use mutually owned companies because they allow you to participate in their success through dividends. That's why we use mutually owned insurance companies. Plus, the mutuals are more aligned with you and your goals than the publicly traded. The publicly traded insurance companies, we don't use them because they're aligned with their stockholders. That's who they're paying dividends to. You might get a dividend, but you're getting the tail end of the stick, because they have to satisfy their stockholders before you. When you participate with a mutually owned life insurance company, you effectively are an owner of that insurance company in a roundabout way. By you owning a policy and participating in that insurance company's success, you are acting in the owner capacity. So that policy that we got to design, and we're going to show you how to do that. The reason we use whole life insurance, we don't use IULs, we don't use anything other than specially designed whole life, because here's why. You, in order to become your own bank, you need to capitalize your banking system, which means you need to fund and save money in your bank. Your bank, just so you know, is the whole life insurance policy. But why would you do that? That's the question everybody should ask. When I first heard about this, I'm like, why would I put my money in a whole life insurance policy? And I probably said it just like that, because whole life was like the worst place you could put your money. First and foremost, why we use a whole life insurance policy, I can sum up very simply. And it's right over here on the board. So let's just kind of go through some of this. First off, by changing where your savings goes first, by capitalizing your banking system, you are giving yourself a guaranteed interest rate. You aren't, but the insurance company is giving you a contract with a guaranteed interest rate that never changes. Your bank account might be paying you interest today, but if today, hey, Stephen, did they call out the interest rates? Are they changing them, keeping them, or is that not yet?
Let me check. I'll check in.
Okay, so I know Jerome Powell is going to make an announcement today whether they're going to raise interest rates, lower interest rates, or keep them the same. Just so you know, they're going to keep them the same. But nonetheless, if Jerome Powell today decided to drop interest rates 50 basis points or 0.5%, your bank account would be reduced. In most cases, it might not happen today, but it would happen in a week or maybe 30 days. Your interest rate would reset to a lower interest rate because it's controlled by the Fed. You see, in the insurance company, you have a contract with the insurance company called the policy contract. That contract has a guaranteed interest rate and it never changes. So I'll give you an example. One of the insurance companies, actually two of the insurance companies we work with pay 3% guarantee, which means you can never, ever, ever earn less than 3% on your money, period. But remember I said they're mutually owned insurance companies. So therefore, you don't just get the guaranteed interest, you also get dividends. The dividends are not guaranteed, but they have never, ever not paid one. They paid them through the Great Depression, through the Great Recession, through COVID. They've never missed one. Never, not once. So the chances of them paying dividends into the future are really, really good. Okay? So if we add the interest rate that they guarantee you plus the dividend, today, all of the insurance companies that we work with pay between 5.9 and 6.6%. Let's just say that again. They pay a dividend crediting rate of 5.9 to 6.6%. That's the gross, okay? Policy service fees come out of that, cost of insurance comes out of that, and our commission comes out of that, which I already told you I'm going to explain how we reduce our commission through the design. Fair enough? So that's better than what most banks pay, right? Over a long period of time, if you never performed the infinite banking concept, you just put your money in that stupid whole life policy and let it sit there, your internal rate of return would be anywhere between 3 and 5%. Depending on the company and a couple other factors like age and health, okay? So when we're looking at this, I think the thing that you all need to understand, and I want to just read this right because this is perfect. Everything we're going to talk about today depends on your season of life, but it also depends on your reason. There's seasons and reasons. Now, what I mean by seasons is in your life, when we're younger, we're healthier. As we get older, we have health elements. Things happen, different seasons as we age. And as we age, our reasons change. When we're young, we want to pay off debt. We want to, figure cars out. When we get older, we want to start thinking about retirement and investments and legacy and protection. Well, speaking of protection, let's go one step further. The whole life policy provides protection in the form of most policies, or I shouldn't say that most policies, all policies in most states are protected against judgments and liens. So if you get sued, they can't come after the assets, especially if you live in Florida. Florida, I just pick on a lot because you guys have good rules. 100% of your cash value. You could have $10 million in cash value and you could get sued for $10 million and they could know all about your policy's cash value and they can't touch 1 red cent of it. Okay, period. It's protected. Not only that, it's private. So I don't know how they would find out how much you had in cash value because it's completely private. You don't need to tell it to anyone. The government doesn't have to know about it. The IRS doesn't have to know about it. Your neighbor definitely doesn't know about it unless you're in the backyard bragging about how much cash value you have in your private banking system. Well, then they know. But who cares if they know? You know they can't take it. So it's just bragging rights for you. But remember I talked about the guaranteed interest and dividends? They grow tax-free. The way you're going to see us design these policies today, we're going to design them so that all of your future growth, your internal buildup of your cash value is 100% tax-free, as long as it's designed properly. The other thing too, there's no volatility and there's no restrictions. So you have liquidity of your money. Okay? The insurance company isn't going to do what the bank does and say, well, why do you need your money back? They'll never ask you why you need your money. They don't care. Okay? They'll just give it to you. Good, bad, or indifferent. And not only that, they won't ask you to fill out 1099 forms. Or, sorry, W-9s, not 1099. So they won't send you a 1099. The bank will. And there's a death benefit. Now, I want to just take a second here. Your bank account, your investment account, your 401k account, none of them pay a death benefit when you die. They might be good when you're living, right? They have benefits. But when you die, the only thing that is going to pay you out a tax-free death benefit is life insurance, folks. So all those benefits we just went over, those are all great. But the one guarantee in life that we have outside of taxes, which we already addressed, is death. So when we die, wouldn't it be better if we had our money in a place that paid our family, our beneficiaries, our trust, whatever it might be, a big chunk of money, tax-free, that was leveraged up just because you decided to be your own bank? So listen, those are all the reasons why. Why would we use whole life? Well, I just gave them all to you. Why would we not use IULs? Because they don't work for this. IULs have their place in the market. That place is in the future. We are talking about today, now. You build a banking system to do things today, not to do things 10 years from now, 20 years from now, not to worry about saving for your retirement, although this will help you save for retirement, but it is not the sole purpose. You see, when you create a banking system, the purpose is not one-dimensional. It is everything. You are going to finance everything in your life through your private banking system. You're not going to just finance your retirement. You're not going to just finance your car. You're not going to just pay off your debt. You're going to do all of that because it's this and that. You're going to make money on the policy, and you're also going to make money on all the things you use the money for throughout your lifetime. Okay, so those are really important things. Now, let me just get through the dynamic of how it works, because this is very simple, and it's just like a bank. All of you have a need. You wouldn't be here if you didn't. I mean, how many do we got? 116 people here. We even have some financial advisors. Thanks for joining us. You're all here for one reason or the other. Maybe you're just here to learn. Maybe that advisor is here to learn so that they can then pass this knowledge on to their clients, which is fantastic. I wish there were more advisors on here because more advisors need to know this, learn this, use this in their practice. So whatever you're here for, your need is different than the person next to you. So Michelle's need is savings, Brett's need is different, and then Tessa's need is very different. So all of you have a different need. But let me just fine tune, just for explaining this, one thing. Many people in the United States of America, probably the world, have debt. They have debt and they don't want it. They want to pay their debt off. And they go through a lot of things to try to pay off debt. But let me show you how simple debt payoff is. And Craig has software and a book. If any of you want the book, it's called the Debt Blaster Trifecta. It is out on Amazon. And also, if you want the ebook, Craig, I think, has a link we could share with all of you. And we can basically, we can give you that book. It will show you how to pay off your debt the most mathematically efficient way. And here's the best part. Without working harder, without working longer, and without taking on any risk. How about that? You can pay all your debt off in a fraction of the time, and you don't have to work any harder, any longer. You don't have to make any more money, period, right? If you knew how to do that, you and your family would be in a better place. But here's how it works. You start saving in your policy. So you change not your full income, but your income that you would normally save, because you're either spending or you're saving. The problem with most people is they all spend first and save what's left. That means you're not paying yourself first. That means you're violating the first law of wealth. So what we all need to do is fix our mindset and our habits. So let's do that right now. The first thing for you to be your own bank is you have to pay yourself first. Now, this is hard, and I tell thousands of people to do this, and it works for all of them that apply this. Try this. Before you pay a single bill, before you spend a single dollar the next time when you get a paycheck, keep 10% of it, or keep some amount of it. If you receive a paycheck for $1,000, keep $100 of that. Put it somewhere. Put it in a different bank account that you can't touch. Put it in your own policy, but put it away where it's somewhere else. Then after you pay yourself first, that $100, then you got $900, go pay your bills with that. Now, many of you would be like, I couldn't do that, Chris. I wouldn't have enough money. I wouldn't be able to pay my bills. You're wrong. If you believe you wouldn't be able to pay your bills, guess what? You won't be able to pay your bills. If you believe, and I can't explain this foo-foo stuff, if you believe that if you pay yourself first, everybody else will still get paid, that's exactly what will happen. But you must believe it first. You must believe that worthy idea in your mind. Without that, I can't help any of you. Until you all start paying yourself first, until all of you start saving money first, none of this works. Because you will be plugged into their system if you pay them first. They will be in control. They will control your life, your family's life, the outcome of everything you do, because you have prioritized their needs before yours. So that's first. Then once you do that, we change where the savings goes first, and we put it into this specially designed whole life, which we already went through why this is the vehicle of choice. Now, what we're going to do, let's just pick on an example. I'm going to give you an example here, and I'm just going to wing this. You've got a $10,000 Visa balance The Visa is charging you 20% on that credit card. You are paying Visa aggressively trying to pay this thing down $500 a month. Oh, that's probably sounds familiar to some of you, right? Guess what? I know what's happening. The Visa never seems like it's being paid down, does it? It never seems like you're making any progress. It seems like you're just at a standstill. You're on a hamster wheel. It's because you're doing it wrong. You're just doing it wrong. It's okay. So here's what you would do. Over here, let's just say you saved up, let's just call it $5,000. I'm just going to use that. You saved $5,000 over the course of 3 months in cash value. What you're going to do is you're going to take a $5,000 loan from your private bank, which is the policy. Now, here's an interesting thing. If we had $5,000 in cash value, so Bliss, I want you to pay attention to this, okay? Because I know you were asking about why whole life and not IUL. This isn't a why, but this is something I want you to understand. If you had $5,000 in cash value and you had a Visa for $10,000 that you wanted to pay down, it would be nice to have access to all $5,000 of that money, would it not? In an IUL, you would not. You'd have a surrender charge. Even with the high liquidity option or riders, like the early cash value withdrawal riders, most of them make you wait a year. I want to do this immediately. I want to put money in this policy. If I had $5,000 in a bank account and I put it in my policy, man, I want to be able to take that money immediately in the first 30 days. You can't do that in an IUL. But now the $5,000, if we had $5,000 in cash value and we took $5,000, how much money's left? So Bliss is already saying, yes, it would. I don't know if that's what you mean. Yes, it would, but we'll get into that. How much would you have left? Dottie said $5,000. You're absolutely correct. Because the $5,000 that you took, the loan you took, was not your money. Your money acted as collateral. So whose money is the $5,000 you get to use? It's the insurance company's money. They lend you money from their general account. Literally, they take the money from your death benefit. So let's just say your policy is $500,000 of death benefit. They're going to take $5,000 from that $500,000. So if you died the next day, $495,000 would be paid out. That's the true up. That's why the insurance company will never ask you to pay back the $5,000 loan. They don't care if you do. They'd probably prefer you don't, because the $5,000 loan you took out earns the insurance company interest, because they're going to charge you interest on that money. Now, I know some of you are like, oh, see, I knew there was a catch. I knew there was something here. I don't like that. I don't want to pay interest on my own money. But hold on a second. Let me ask you a question. How many of you think that doesn't make sense? You're going to save money in this account, and then you're going to take a loan from that account, and you're going to pay interest on your own money. That sounds silly, doesn't it? Silly. But hold on. Let me flip the script here. Let's just say you had a bank, that you had $5,000 in your bank account, and the bank was paying you 5% on that money. But that same bank allowed you to borrow from the bank at a rate of 3%. How many of you would take that 3% loan and leave your $5,000 in the bank earning 5%? You literally would be making 5 on your money, 5%, and you'd be able to borrow your money or borrow the bank's money at 3%. All of you would take the loan, right? Robert's like, every day I'd be taking loans. Yep, you would. So now let's come back over here. How much did I say that the whole life policy pays? 5.9 to 6.6. Now let's just keep this general. This isn't the exact numbers, but we can get into those with the vol. Let's just say you were earning 6% on your money inside the whole life, and you could borrow at 5%. Isn't that the same thing? You would be doing what a bank does, because you'd be making a spread. But you see, it gets even better. What if every year we could make that spread go up? What if every year that spread automatically went up? Because it does. Let me show you how. We take the $5,000 loan that the insurance company gave us against our death benefit. We come over here, and what we're going to do is we're going to pay down the Visa to $5,000. Now, what that's going to mean is now we probably don't owe Visa $500 a month. Let's say we owe Visa now $200 a month. We just freed up $300 a month in cash flow that we used to give to Visa trying to pay them off. So now what you're going to do is you're going to take that $300 extra, okay? We're going to deposit that in your bank account, preferably a segregated bank account, so that you could track this and see this. And then we're going to recycle and recapture that $300 a month up into the whole life insurance policy as a loan repayment. Now, let's just do some quick math here. Grab my calculator. So if we did that every month, we put $300. After 12 months, that's $3,600. $3,600 that we put back into the whole life as a loan repayment. How much money would you have to use after you put $3,600 back in the whole life? Dollar for dollar, you'd have $3,600. Every month you put the $300 back in the policy, you have $300. So why would we leave it in the bank? We shouldn't. We would put it back in the whole life policy as a loan repayment, because here's what we just did. We just repaid $3,600 of the $5,000 loan that they were charging us 5% on. So let's just do the math. If you got a $5,000 loan and you're paying 5%, the insurance company would make $250. But now we lost no liquidity, but we just changed the way we're using our money and the way our money flows. We put $300 back into the whole life. Okay? Now that $300 we put back paid the loan down. So now we paid $3,600 get my thing right, minus $3,600 of the $5,000, $1,400 is remaining as a loan on your private banking system. But now the insurance company is charging you 5% on $1,400, which is $70. $70 divided into 5,000 is 1.4%. So now how much did we have to pay in an APR? Well, we thought it was 5%, but now by the math, it's about 1.4%. So if you were making 6 and only paying 1.4, did your yield or did your spread just go up? Of course it did. But there's another thing that happened. The $5,000 that was in your policy never stopped earning. You didn't lose that opportunity to earn interest on that $5,000. It continued to earn, but you still were able to use it. You still were able to succeed in what your goal was, which is paying down debt. But maybe your goal is not debt. Okay? Maybe your goal is to finance a car, a boat. Maybe your goal is to buy a house. Maybe it's to finance your business, finance a marketing campaign, buy out another business, whatever, buy a copy machine. Maybe it's real estate or investments. It doesn't matter what it is. The rules of engagement are the same. You rinse and you repeat. You don't lose liquidity of your money. You control your money. Your money then works for you. Your money then also allows you to do what a bank does, making the arbitrage. I know I went long on that, but I wanted to hit that because if you didn't understand that, folks, you wouldn't understand what we're going to talk about next, what we're going to talk about next is we're going to go into how to design this whole life insurance policy so that it gives you the maximum cash value.
George just said, could money from a traditional IRA be withdrawn after 59 and a half and put into a BYOB policy, then withdraw 90% from the insurance policy as a loan and put back into the Roth IRA?
No, you're thinking about that completely wrong.
Policy. Yeah, you're not going to want to do that.
You would never want to do that, George. It actually, first and foremost, there'd be no reason to put it back in the Roth, right? If you had the money in the Roth and you took the money out after 59 and a half, the money came out tax-free. Could you put that into the policy? 100%. But you would never then take a loan from the policy and put it back in the Roth. For what reason? Like you're not, that wouldn't allow your money to earn more for you. But here's what you could do. You could take a distribution from your Roth, okay, put that money into the policy, then take the money from the policy and pay your car loan off, take the payment you were making your car loan, okay, to your car loan. Now that you no longer have to pay that to the finance company, you pay that back to your policy. And now your policy is doing what I just showed you in building, and you're making money twice on every single dollar. But you would never really be, never really be a reason to get it up into the Roth again, because the reason it started in the Roth, I would have to guess, is because you wanted it to grow tax-free into the future. The policy already grows tax-free. So the Roth and the policy are both tax-efficient vehicles. The Roth grows tax-free, just like the whole life's internal buildup. So if we just took the withdrawal from the Roth and we put it into the whole life, we've accomplished the same goal as we did with the Roth, except for now we got a death benefit. We got additional protections. I mean, the Roth has good protections against judgments and liens, but not as good as the life insurance. But we got a death benefit, and we got guaranteed growth and the ability to earn twice. See, in the Roth, when you take the distribution, you don't keep earning on the money that you took out of the Roth. Follow? So that's a good question. What else?
Yeah, here's one. So they just asked, so keep taking out loans against your policy to capture the spread. What could the loans be used for?
Yeah, Oscar, that's a super good question. Thank you for asking that. So the goal is not to put money in the policy and just take loans out. The goal is to put money in the policy for a particular goal. And those goals are kind of what I mentioned. They can be anything because that's why it's called infinite banking. So the goal could be, if any of you are in debt, that's your first goal. Nope, whether you think it is or not, that's your first goal. We want to pay the debt off because the debt is just money going down the drain. It's like a hole in your boat. And until you patch that, nothing else is going to get better. But after all your debts are gone, you're still going to finance things throughout your life, Oscar. You're going to still buy cars. You and your significant other or spouse and your kids, they're going to need vehicles. They're going to need financing. Maybe you've got a business. Maybe you're an investor, like a real estate investor. Maybe you invest in crypto, whatever it is you know, like, and understand that you want to invest in, then you could use this money for that. But the goal, you got to understand, this is a simple golden rule for IBC. If the insurance company, and this is how I always do it, and again, there's caveats to this, and someone's going to call me out on this, and Chris, that's not always how it has to be. Basically, what would I would use as a rule? Sorry, my screen isn't working. What I would use as a rule is if the insurance company is charging me 5% in interest, hypothetically, I need my money to earn more than 5%. So anywhere I can take that loan and put it where it can earn anything more than 5%, then that's what you do. But then you have to take whatever that money earns and roll it back into your banking system, back into your policy. Otherwise, you're not being your own bank. You're stealing from your bank at that point. And that never, I don't know any bank robbers or people that steal from their bank that get ahead. Usually they end up in jail, but because this is your own banking system, they don't throw you in jail for stealing from your bank, but it's still not good. What else do we got?
All right. And then Juan, just maybe clarify how the premiums work a little bit. He was asking for the $500,000, what is the mutual life insurance payments?
Oh, we're going to get into that in design. So I'm going to pause that question.
Okay. All right, Juan, we'll come back to that. So we actually build these kind of backwards.
Yep.
And so the
Yeah, it's backwards. We don't start with a death benefit. And you'll see that in just a second.
we'll get into that. Michelle said, for stressed families, what minimum amount of money could this get started to accomplish debt payoff?
Yeah, 10 times your age. Now, listen, there's another thing too. I can see these questions where they're going. We get these every time we do a webinar or a live training. So what we've got, first off, I can't stand when I get interested in a company or I see something that I want information in, and then I got to search and I got to try to figure out who I have to talk to, what their phone number is. Doesn't that piss you off? The other night, we saw a property that we liked, a rental, and we're like, oh, who could we call to ask about seeing this? It was impossible to find the guy's number. Then we found the guy's number, but we had to literally put our information, and we had to give him our name, our address, all this stuff. I'm like, this is bullshit. And then when we did that, gave us his number, I call him up, and I get to talk to AI. You talk about pissing somebody off. Now I'm talking to AI. Blah, 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 so-and-so, tell us what you're calling for, and we'll blah, blah, blah. So I did. And then it pretends like it's going to go check with the person, like they want to take my call, and it comes back and says, this person's not available. So I left a voicemail and they called me back. I hated that experience. I hated that. So here's how we operate, folks. It's like the Ritz-Carlton. You want to talk to us about something, you have questions, you want to know what the minimum is for you, you want to know what your specific situation would look like, you want us to run your scenario, here's the phone number. Put it in the chat. 866-329-2962. Once you get on there, you will get a recording that will ask you who you want to talk to. You want to talk to somebody about your banking system? You want to talk to somebody about Private Money Club? You click that, and guess what? A human being answers the call. Wow. Novel idea. Crazy idea that actually you can get a human being, and you only had to click one button. That phone number again is 866-329-BYOB or 2962. But you just 329-BYOB, 866-329-BYOB. It's right there in the chat, okay? Or you could see we got another option. You could just schedule an appointment right there, or you could just give us your phone number in the chat. You could just do it in the chat. You could do it over in the Q&A. You could give us your phone number, and then we'll reach out to you, and we'll actually, a human, not a computer, not AI, will reach out to you. So I just wanted to get that out of the way before we get into the plan design, because I can see there's a ton of questions, and a lot of these questions are going to be better suited because they're individual needs in a phone call. And that's it. So you just book a call or you just call the number.
Yeah,
All
and
right.
someone else was asking about IULs. I've always heard that an IUL was the way to become your own bank. Why
You were
would you?
lied to. And
Yeah.
I'm not making that up, AP. You were lied to. If somebody told you that an IUL is what you use to be your own bank, you had a very inexperienced, self-serving person telling you that. Because I'll tell you something. Go on the IBC practitioner's website, okay, and look it up. It is absolutely in concrete writing for to be an IBC practitioner. The only organized, certified way to become an IBC practitioner is through this organization. Okay, it'd be like becoming a CPA or becoming an attorney. You got to take the bar. You got to take the CPA, the whatever I can't think what that test is called. But then you can say that you're a CPA. Then you could say that you're an attorney. Then you can say you're a financial advisor if you get your Series 65, 7, 663, whatever license you get. Okay, but all of those are designations. In our industry, the IBC practitioner designation is the only one. And guess what? In that study work, in that exam, it is highly forbidden to use IULs for the infinite banking concepts. Now, that's not just because they got it out for IULs, not at all. Like they have economists, they had a guy, Dr. Murphy, who literally ran the mathematics, just like we have, to say, does an IUL make sense? Can it work? And it does not work. It doesn't work because the internal build, the makeup of how an IUL works is different than a whole life. First and foremost, your cost of insurance, the cost for the death benefit, every year in an IUL, that cost goes up. So now you're dealing with a vehicle that has an increasing and forever increasing cost. A whole life has a level cost of insurance. It never goes up. Second, almost every IUL, I think all of them, unless there's a special rider put on, have a surrender charge. Which that example with the $5,000, if you put $5,000 in and you had, or let's say, if you had $5,000 in cash value in an IUL in the first 5, 7, 10 years, the surrender period, you can't use the $5,000 because there's a surrender charge for taking that out. And what is the surrender charge there for? This is awesome. The surrender charge is there to make sure that the insurance company gets repaid the commission, the big commission that was paid out to the agent. You know why IULs are so popular? You know why they're sold by so many agents? They have the highest commission. It makes perfect freaking sense. Why is it that you've always been told term insurance, term insurance, term insurance? Because it's the most profitable for the insurance company. You see, the insurance companies have this game figured out. An IUL is an incredibly profitable product for them. I could go on for days, but I'm not here to make this whole training about IUL versus whole life. I have 6 videos on my YouTube channel. You want to know why IUL should not be used for IBC? Google it. Ask AI it, or watch one of my 6 videos, or Chris Kirkpatrick's videos, or any other IBC practitioner's videos about IULs and why they should not be used for banking. Period. End of story. Like they're just not a good fit. And if you want to force a round peg in a square hole, by all means, grab a big old fucking hammer and start wailing away and let me know how that works. Because that's what you're doing. That's what you're doing with an IUL in banking. I don't mean to be a dick, but seriously, like the question's got to stop on that because it's a good question, but there's a very viable reason why everybody that does the infinite banking concepts uses whole life insurance and not IULs and why they're forbidden. Anyway. Any other questions that are not IUL?
No, I was responding just through text on some of these, so I think we can keep rolling here.
All right, cool. Well, let's get into this. So I want to now change the screen, and I want to kind of go into this. I'm going to use this and the whiteboard, and Craig's also going to help me. But what I've got here is just a simple design, okay? And we're going to look at several things. So actually, let me start with this. Okay, everybody can see that?
It reminds me of those old projector things.
Isn't it cool?
Right on. Yeah.
Listen, man, if we're going to go back to just like giving people a phone number to call where they actually talk to a human, let's get back to like the old projector days. So like that's what we're doing. So this is a specially designed and engineered whole life insurance policy. The subject that we're using here is a male, 35 years old, at a standard non-tobacco. Now you might do better. You might get a preferred rating. So this is kind of those different seasons, but we always show standard because we know if you're healthy, you're going to get better than that. But if for some reason we show you preferred and you get a standard, it's going to not look as good. So we're showing standard. And what we're doing is we're showing somebody that has a lump sum of $100,000. Okay, they got 100 grand sitting in a bank account. Now listen, folks, if you're like, oh, I don't have 100 grand, this is just an example. We're just using this just as a baseline. If you had 10 grand or if you just had a monthly amount to save, that's fine. This is just an example. This person has $10,000 or sorry, $100,000 sitting in a bank account that they want to dump into the policy because they want a better return on that 100 grand. And then every year they want to save $12,000 or $1,000 per month. Okay, so this is $1,000 a month that we're doing into this. Now I want you to look over here. In the first year, you put in $112,000, $100,000 dump in, $1,000 a month, or $12,000 for the premium deposits. Over here, if we look, the increase in net cash value is $103,375. So you put in 112, you have access to use 103. Now I know that's not 100%, but if we just do that math, what we can see, and I'll just come over here because this is what the Vault software does. If we look at that, that cost, because somebody was asking about cost. Now let's just talk about cost and get that out of the way. We're reducing our commission on this one by, Craig, what is this? This is, we're reducing it probably what, about 70% on this one, give or take?
Yeah, I can look it up, but it's probably in that ballpark.
75, 80% reduction. So the total cost in the first year, you can see it right here, is 7.7%, or 6,000 of your 112, your costs amount to 6,625. Wow, I got to put my glasses on. I know this is small, but we're just gonna talk through this. Okay, $8,625 is your cost. Okay, so you lost 7.7%. That sucks. But for that, you got a death benefit of 1.8 million, well, a little over 1.8 million bucks. Now, if you did this and just did it for 1 year, that would be a loss. That would be terrible. So this is a marathon, folks. This is a long-term thing. But I also want to preface, if you did a normal whole life insurance policy, or you did a regular target IUL policy, you would have no cash value. Year one would be...
Chris, I think you need to pull the page down a little bit. We can't see the top of it.
Aha.
There you go. Awesome.
Sorry about that, folks.
There we go.
This is the first time using this. I think I said that earlier, but for some of you are like, oh, does he not know how to use this thing? Very first time we had this set up because we're trying something new.
You just can't really see the numbers, so just keep saying them out loud.
Yeah, I will. So basically that's your cost in the first year, but here's the trade-off. Now the second year, you deposit $12,000 over the course of the year. Now also in the first year, you have access to that money immediately in the first 30 days. So once you make that deposit of 112, you would have anywhere between probably 98,000 and 103,000 to use. Okay, just so you know. But the second year, you put $12,000 in the policy, $1,000 a month. The second year, you have made a cash-on-cash return on your $12,000 for 11%. Now let me explain that. Let's say we put 112 in and we had access to use, let's use 100 grand of that. Okay, I'm just going to use $100,000 of that was going to go to pay off debts. So we take the loan out for 100 grand and we're doing the recycle, recapture, putting the money back in like I showed you a second ago. Now you've used almost all of your cash value. So it's out there working, it's out there earning interest, it's out there earning an arbitrage. Got it? Now, the second year, you put 12,000 bucks in. The second year, your money grows by 13,323. So you put 12,000 in, you have 13,323 available. That means your money grew, your 12,000 grew by $1,333. That's 11% cash on cash. The next year, you do the same thing, 12,000 goes in, but now you got 14,096. And the next year, the fourth year, you put 12,000 in, now you got 14,934, which is a cash on cash return of 24.4%. Cash on cash would be like if you had new money every year that you invested and you looked at the return on that new money at the end of the year, that's the return that you're getting on this. And it doesn't, this is where this is so special. And this is why a lot of people need to understand cash on cash, because in IBC, the goal would be to put the money in and find a way to make that money go work for you a second time, because you don't dilute the earning potential. In other words, if you put 112 in and you took 100 out, you're still earning the same return, the same interest rate, the same dividend. Nothing's diluted. Yes, you pay interest, but the interest, remember I said the only rule, the golden rule, is if you take a loan, have that money go out there and work at a rate higher than the cost of capital. So if the cost of capital is 5 and you find a place to make it work for 6 and it's low risk, then that's where you go, because your money's all working for you. You're making money twice when you do it that way. But anyway, the thing I want to show you on this before we get into the design, and then I'll go to the whiteboard, seeing as though this is small, is I want to show you down here. This is a really unique thing, and there's not an IUL that will do this, folks. There's not an IUL that I've ever seen that can do what I'm about to show you. In a whole life policy, because of the guaranteed nature and because of the guaranteed growth path, what we can do is we can look at cumulative returns and we can look at a break even, okay? Because the costs in this policy, like I said, are fixed. Your cost for this at this point, now we're in the 4th year, okay? Just making sure you guys can see this. We're in year 4. We've been doing the same thing every year. So in the 4th year, your death benefit has now gone to $1.878 million. So your death benefit has gone up. Now, in the 4th year, you have crossed over your cumulative break even. Is R. Nelson Nash says this in the book. I don't know if I fully agree with how he says it, but he says, how much did your life insurance, how much did your policy cost you after the efficiency point? And he said, nothing. None. Because here's the deal. At this point, you have put in, let's see, how much money? You put in $148,000 right here. Sorry, I know this is small. You put in $148,000 into the policy. That was your capital contribution. That was your capitalization of your banking system. If you canceled the contract at that same time, you would get $145,728. So actually, I should say the 5th year is your break even because this is the point where you break over. So now, sorry, go one more year, 5th year, you put 160,000 in, you could take out 161. Your cumulative break even, meaning from this point on, there will never, ever be a year in the future that you don't have more money that you could take out than you put in cumulatively. See, that same thing when year 2 was your cash efficiency point, where every dollar you put in earns more. So if you put $1 in, you make more than $1, and you could take more than $1 out. That's what we're talking about with this one. That's year 2. But year 5 is cumulative break even. So now that death benefit of, in that year is 1.9 million. That death benefit, there's still a cost there. The cost is completely level, never changes, but you have gotten all the money back in cash value. And from that point, it just keeps growing. So if you look down here, year 10, your cumulative return is 18.1%. Cumulative. Dollars put in versus dollars you have to use. Your cash on cash return is 90%. Okay, so that I wanted to just kind of go over that just so you understood that. All of this one that I just showed you, sorry, I'm trying to make, that's zoomed out. This one that I just showed you here is exactly the same as this. This is just the illustration from the insurance company. Now let's go into how this is designed. And actually, as much as I love this, I'm going to go away from this because we're going to do this on the board because I don't think any of you could see that, right? Can you blow up the sheet next time? Yeah, Frank, sorry. We're trying something new here, guys. And when you try something new, you gotta beta test it and give it a whirl. And we thought you'd be able to see it, but you can't. So I'm gonna come back over here to the board. Fair enough? So let's break that policy design down. When we look at a policy design, there are several components. There is the base. There is term insurance in some cases. There is what's called a paid up additions rider. Sometimes this goes by a couple different names. So these are basically the makeups of your policy. So in this particular situation, we've got $100,000 being dumped in, and then we've got $12,000 a year going in premium deposits. Everybody following that? Okay. So now how much of this 100,000 are we going to put to the base? 0. The 100,000 is all going to go into the paid up additions rider. So right here, we've got 100,000 of your dollars going to the paid up additions rider. Now, the paid up additions rider is unique. And the insurance company, what they're effectively allowing you to do is kind of put money in their general account. And each company has a different load on it, but one of the companies we work with has no load on it. So if you put 100 grand into the one company, you have 100 grand to use because there's no load. Okay, and some of the other companies, the load's like 2 or 3%. So you put 100K in, you got 97,000 to use. Following? So that's basically just how they do it. The paid up additions rider, here's the important thing. The commission is about 2%. So right here, you put 100 grand in, the commission is $2,000. Okay, I'm just trying to do the math for you and show you here's commission and here's deposit. We'll try to keep this nice and simple. And I'm going to also show you what it normally would be. Now, the base is what a regular whole life would be. So if you went to your advisor, you went to your agent, and you put money into a whole life insurance policy, chances are your agent would put 100% of your money in the base. Now, I'm just going to use New York rates. This changes state by state, but let's use New York. The commission rates for base are 55%. The commission rate for PUA is 2%, and the term would be the same as the base, okay? 55%. So let's just do the math. If you put $12,000 into a traditional whole life policy, and Craig, if you want to help with the math, that would be great, because I'm just going to use my little handy dandy here calculator, times 0.55. That would normally be 60. So 12K would mean you'd get $6,600 in commission. But in this design, we are putting into the paid up additions rider 4,000, and I'm going to do this down here, $4,803 is going into the paid up additions rider. So that means 4,803 is earning 55%, or sorry, is earning 2%. So that's a 2% commission. Get these right. So 4,803 times 0.02.
96.
96. $96?
$96.
Okay.
2% of 4,803.
Yep. $96. Okay. Now we've got a term rider for 7 years. That term rider, $1,197 is going into the term, and that's getting a 55% commission times 0.55. So that's $658.35. Now, the base normally in a regular whole life would have been $6,600. So if we did all the math here and we did this into base, your commission would have been, oops, get rid of that, 2,000 on the dump in, because that would be the same. And the term 6,658. So the commission would normally be in a regular policy $9,258.35. Okay, got that written down? $9,258.35. But the way we design it is we're not putting all of it into the base. The base policy is getting $5,999. Now, again, this design is always going to change. It's going to change because of the dump-in. The dump-in requires more base to make it more efficient. I know that doesn't make sense. A lot of the other gurus out there will tell you that that's wrong, but it isn't. We've done the math, and we have software to prove the mathematics. So 5,999 times 0.55 is $3,299.45. So if we did the math on doing it this way, what we would make is, let's see, we'll add this all up, $32.99 plus 658 plus 2,000 for the dump-in plus, I think I did this right, 96 for the PUA. So $6,053 is what the commission would be on this particular design. How much did I just say the other one was? Was it 9,000?
I think I wrote down 9,235, but I'm not.
9,235?
Yeah, that's what I wrote down.
235 minus 6,053. So that's a $3,182 cut in commissions. Now, let me explain something. This design was the maximum efficiency for this particular makeup, for this particular reason or season, if you will, where the person wanted to put $12,000 away, $100,000. Now, let me do one other one. I'm going to use this same scenario, but now we're going to get rid of the dump-in. Somebody just wants to save $12,000. Let's do this again. Got base. Actually, let me move this down. And Stephen, any questions come up on that one? Because I don't want to run over questions.
I'm not seeing any yet. Keep them coming, though.
Term paid up additions. Okay, so now in this scenario, if you had $12,000 you were putting in with no dump-in, you had no dump-in that you were doing into the account, now what you could do is you could eliminate the term. The term insurance rider in the last one, which cost you $658, I think is what I said it was, that term insurance rider is only on there, or sorry, the commission was $658. That term insurance rider is only on there so that the policy can be built within the MEC 7 pay rule, meaning it can be built to grow tax-free. If we were to put more money in or not design it under the IRS rules, your future growth in the policy, which would technically be all the growth after that 5th year, like I mentioned, cumulatively, that would all be taxable. So the term rider allows us to build the policy, keep the costs low, keep the costs on only as long as the IRS needs them, which is 7 years, and then we drop that term rider, which you couldn't see the thing, but you would have seen on there in the 7th year, or actually the 8th year, the death benefit drops because we got rid of that term. In this scenario, you would not need that. So now what we could do is we can ratchet this thing up to be anything. So let's just say it was 80%. Okay, so if we did that, $12,000 times, here, let's do what the normal commission would be. So 12,000 times 55%. This is what a normal whole life would pay $6,600. That would be your commission if you did a regular whole life. If you did a IUL, it'd be way more than that. But the way we're going to design this is, let's just say we put 80% of this 12,000 to the paid up addition rider. So $12,000 times 0.8, that means $9,600 is going here. And then what that means is now we're going to put the remaining $2,400 to base. So let's do the commissions. 2,400 times 0.55, that's $1,320. And then 9,600 times, 9,600 times 0.02 is 192. So 192 plus 1,320 is $1,512. So 1,500 minus 6,600 means the commission was reduced by $5,088 in this particular scenario. Now, I just did New York. If it was another state, the commission difference would be much bigger because the commission rates are higher. I just wanted to kind of give you that example. But when we design these policies, the way we're going to design it is going to be for maximum cash value efficiency. So if you remember in that very first design, and I'm going to try this again just so you can kind of see this, but I want you to just kind of try to use this as best you can. In this one, I just want you to look at the colors because I know you can't see. So right here, this is the first year, the money going in, the 112. Second year, you're efficient. The second year, you have cash value, cash on cash efficiency, meaning you put 12 grand and you can take more than 12 grand out. The 5th year, right here, is the cumulative break even, meaning every dollar that you put in from day 1 till year 5, you have made more money than what you've put in. It will continue. Notice how it's green the whole way down through. Now, the costs are fixed, so there is no change in cost. Therefore, this remains constant. The only variable, the only thing that can change in a whole life insurance policy is the dividend. For the last, correct me if I'm wrong, Stephen and Craig, for the last 3 years, or maybe it's 4 now, every year the insurance companies have increased dividends. Am I correct in that?
That is correct.
Yes.
So we've seen dividends go up. Now in the future, like over the next 20 years, we'll see some movement, probably down and then back up, but it'll be very small movements. Okay, so your dividends are pretty consistent, but they are not guaranteed and they do change. So that's the only moving part in the policies, which is really fun for us right now because 6 years ago, 7 years ago, 8 years ago, when we were doing policies and we gave policy illustrations like what you just saw, and those clients go back to their original policy illustration and they look at their new policy illustration, it has performed significantly better than what it was shown at because dividends went up. Now, I can't say that for IULs, and I don't mean to pick on IULs, but there was a couple people asking. In IULs, we did a challenge, me and Chris Kirkpatrick, and if any of you are IUL agents, take me up on this. We offered $10,000. 5 from me, 5 from Chris Kirkpatrick. For anybody, any agent, any advisor that could show us an illustration from 10 years ago that was sold, show us the original illustration 10 years or longer ago, and then show us an in-force illustration today. It could be 10 years in one day. The reason we did 10 years is because we were just trying to give the IUL agents the benefit of the doubt. You know, because in 10 years, folks, look at the markets over 10 years. We've been in the longest bull run in history, period. So over 10 years, everybody's made money. Every index has made money. No ifs, ands, or buts about it. So we just said, hey, let's give them the upper hand. And we just said, all you need to do is show us an illustration that outperformed your hypothetical rate that you showed day 1, 10 years ago or longer. How many of those people do you think have gotten a $10,000 check? None. If you were an agent and an advisor and you could make 10 grand just by showing a old illustration that you have in your file or in your inbox and a new in-force illustration, which would take you about literally one email to get or one click of a button to get, and you make 10 grand, would you not take advantage of that? Hell, I would. I would have my entire team finding that illustration. Hey guys, find the unicorn, find the one that beat. And then I would submit that for 10 grand, but nobody's done that. And we've gone public, YouTube videos, we've done webinars on this, we've done trainings on this. Nobody has come forth saying that they have this. So you asked, why not use IULs? Because they are sold on a false promise. They are a flawed design and they just don't work for IBC. All right, so with that, Stephen, any questions we should hit before I turn it over to Craig to kind of get into the vault and really get into the design factors?
Let's keep it rolling.
All right. Show is yours, Craig.
All right. Well, I'm going to be asking for audience participation in this next section because everything Chris just went over, we're going to do a little test. But before we do the test, I'm going to do a quick review with you. There's a lot on here, but I wanted to go through. We're going to talk about the ingredients that Chris just went over. And then I'm going to show a few policy designs and I'm going to ask you which one is the best. And so, is everybody ready to participate? All right. So the first things we want to talk about are some of the different ingredients. We have cash value, and let me back up one point, because when you have a call with our team, one of the things we're going to do is understand what is your specific situation, what's your cash flow look like, do you have dump-ins? What are you trying to do with this policy? Are you paying off debt? Who are you? Are you, someone that you're trying to build a policy for children? Are you somebody that's a real estate investor in your 30s or 40s? Are you someone closer to that retirement age, 50s, 60s? Because all of these things, Shauna was kind of queuing us up and saying, hey, we want to talk about the seasons of our lives. So we may design policies completely different for children than we would someone in their 30s or 40s, someone in their 50s and 60s or 70s. So we need to think about the season of life we're in.
Hey, Craig, let me add also, seasons of life obviously change as well. And so what we want to do right now on this first call with you, this first policy, is solve for the reason and the season of your life today. What does that look like right now? Because as time moves on, your life changes, your goals change, your financial situation change, your family changes. And so, the right policy for you today might be different than the right policy for you next year and 5 years and a decade from now and so on. But that's the beauty of what we do with becoming your own bank. It's not one policy for the rest of your life. You start accumulating multiple policies and you stack policies and you add policies as your life adapts and changes into the future. And so it's all part of it. So when we talk now, though, let's talk about how we're solving that for you right now today.
Yeah. And so there's reasons and there's seasons, and we want to think about all of that when we're doing policy design. And so here are some of the ingredients. But before I show you some policy designs and ask you some questions about those, take a screenshot of this. You can study it after the webinar as well. But we're typically looking for policy outcomes. And what those outcomes could be is we might be solving for a certain amount of cash value at a certain point in time. So maybe we're trying to build a policy to fund children's education, or maybe we have a new car purchase coming up at a certain point. So that can be one of the design considerations, is the liquidity, the cash value that we need at a certain point in our lives. We might be thinking about death benefit, although with the infinite banking concept process, death benefit is typically something we don't talk about, but it is very important. Maybe we're trying to do infinite banking strategies for major purchases, but death benefit may be part of the equation. Okay, so we have cash value, we have death benefit. Then we talk about this MEC thing, which is a modified endowment contract. And just think of this as a set of guardrails that specify how much can we put into a policy in terms of cash related to the death benefit. And if we exceed certain expectations, then it could be taxable. So everything we do all the policies we design are going to be non-mechs. We're not going to design a policy that's going to go into a mech. However, think of a mech as like a box that we can put money into. It's creating the size of the box or the capacity to fund the policy. So if I want to put a $100,000 dump in, I need to create the capacity to do that. If I don't want to put a dump in, I don't need as much capacity. So those are things that we're going to talk about in terms of some of the outcomes that we're looking for. Now let's go down to this next session where we're talking about base, PUA, and term rider. Chris has already shared with you some of the ways the commissions break down, but think about the base is kind of that foundational component. This is where we have permanent whole life insurance, we have guarantees built on that, we have death benefit associated with that. But then if we look at number two, where we have this paid up additions, this is the thing that's creating that high early cash value. So when Chris said, "Hey, we're putting 100,000 in here, we can pull out 90, about 90% of that." That's going into paid up additions, but guess what it didn't do? It didn't create much death benefit. So when we think about just between base and PUA, the higher the base, the higher the death benefit, the lower the cash value. The higher the PUA, the less the death benefit, the higher cash value. All right, so does everybody get that piece? The higher the base, the more the death benefit, the less cash value we have. The higher the PUA, the more cash value we have, the less death benefit we have. So you see we have a couple levers there that we can turn based on your specific design. Now let's shift over to the term rider. Why would we do a term rider? When we put a majority of the premium into PUAs, or we put a big chunk of a dump into the PUA side of the equation, we don't have enough death benefit to satisfy the IRS to be underneath those MEC rules. So what do? We add term, we add more capacity to fund the policy. So the more PUA we have in relation to the base, a lot of times we need to create more MEC room. We need to create more term insurance inside of the policy. All right, so those are some of the relationships. Grab a screenshot of this. If you ever need to go back and look at it, you can go and say, okay, base PUA, how do they relate? How does PUA and term relate? Now, there's one other thing with the term. We typically can have that on for, say, 7 to 10 years. But is there anybody out there that would want a term rider for 20 years versus 7? Can anyone tell me why I might want a term rider for 20 years versus 7 years? And just put in the comments if you have the answer. So for the term riders creating space, it's capacity for us to be able to put more in. Okay, Felix has got put more dollars in. You're absolutely right. So I might get to a point where I want to continue putting in the most amount of paid up additions that I can. And so I'm going to create more room in my policy with term riders. And so that's a design consideration as well. All right. So thinking about all these, I'm going to give you 3 policies and we can kind of talk a little bit about the policies, and they're going to be very similar to what Chris was showing you. But this is a kid's policy. You can see that they're actually starting the policy at age 10. By the end of the first year, they're 11 years old. They're going to be putting in $6,000 a year. Now, I'm going to show you 3 policies, and I'm going to ask which is the best one. And so you all have to vote on policy A, policy B, or policy C. All right. So if I'm putting in $6,000, I put it in for 10 years, and then it drops down to essentially 2,400. And that's just a reflection of how the policy is designed. If we want to put more in, we can. But let's just look down here at year 20. We have a cash value of 133,000. We have a death benefit of 449. That's policy number 1. Policy number 2, or let's call it choice B, we're putting in $6,000 for almost 16 years, and then we start putting in 3,000 as opposed to 2,400. Now here we have 161,000 of cash and a death benefit of 546. So it's more, we put in money longer, but we have more cash value and we have higher death benefit. I'm going to show you one more, and then I can flip back and forth if you want to look at them. Here's another one called Choice C, where we're only putting in premiums for 10 years, and then we put no more money in for the rest of the policy's life. Now, at the age at year 20, we have $107,000 of cash value and a death benefit of 291. So now I've kind of given you three different policies and what I want to ask and put in a vote of A, B, and C. Which is the best policy for Minnie Doe, this 10-year-old child? Terry's coming in with a B. We've got a C. We've got a B. No one's picking A. It's kind of interesting. We have a B. We have a C. So, Chris and Steven, why do you think some people are picking B, some people are picking C, and nobody picked A? Any thoughts? And is there really an answer? Do we really have a best of A, B, and C?
I like that one because there's really not a best. There's only a best for that person's particular situation.
Yep. There's no right answer here.
I was like, I wanted to answer the question, but then I'm like, I don't really like any of his answers. Then I'm like, I don't really agree with any of that, so I'm not going to just say it.
Yeah, and I did this on purpose because there really is no best choice. Because now what I want to do is I want to walk through these three designs in a little more detail. Some of you pick B, some of you pick C. And I'm just assuming that the people that pick B probably had a mindset of, hey, I want to fund this thing with as much as I can for as long as I can because the cash value will be higher for my child, the death benefits will be higher. And then some people may have said, well, I like C because I get to fund it for 10 years and then maybe I change ownership over to my child who's now going to be 21 and I'm not giving them a policy that they have to continue funding. But let's look at this thing. It's called a 10 pay, where you're putting in premiums for 10 years. And then after that, you're no longer putting in premiums, but it's still growing 34, 33, 36, 18, 38, 13. And, even at age 21, Minnie Doe would have over $67,000 to use. So this might be a case where the parent has a design to say, hey, I want to fund this for my child for the first 10 years. I'm going to change ownership, give this to them as an asset. I'm not giving them something that they're burdened with maybe putting in premiums. Maybe they don't have a job at that point. Maybe they're in college, or maybe they're just getting started out with their career and they can't sustain a premium. This is a good plan because they don't have to put anything in, and now they've got $67,000 to use that they can borrow, pay back, and they have this great asset. So if that's your goal, this might be your best option. But now let's go back to some of the folk, some of the people here. We've got Dottie, Katina, Sonia, Eva, that all answered B. So you might be thinking, hey, I want to be able to stuff as much money in this as I can for as long as I can. And so what we did is we kind of crafted the design where I could continue putting in money for, the 6,000 for almost 26 years. Well, by being able to do that, I was able to generate a higher cash value, a higher death benefit. And at this point, even if I transferred this, policy over to the child and changed ownership at maybe when they're 20, 21, 25, they can continue to keep funding it, maybe $3,000 a year. So why I'm bringing all these things up is because there are different strategies for the seasons of life that you're in and the specific reasons that you want to do these policies. So if maybe I'm building this up so they have some money to maybe start a business, or maybe my child's not going to college and they do want to start a business, or maybe they need money for, funding a car or just kind of kickstarting life. You have three different options here to choose from. And that's what we do in our strategy sessions is we listen to what are you trying to do? How long do you want to fund this? So those are some of the strategies. Now, what I want to do is jump into some of the policy designs. And Chris, there were some questions when you were going through it of people asking, well, hey, how do I get to see this for my own policy? And that's where we've got this software called the Vault. You can find it at byobvault.com, where you can upload your policies and you can get these different views, just like we're showing with the cash on cash, cumulative returns. But more importantly, it's not just showing you the policy performance, but how do I use it for debts? How do I use it for major purchases? How do I use it for opportunities? So I might be using my policy to launch, an investment. I might be using my policy to help me with paying down debts. Or I might be using my policy as a way to buy cars, major purchases, forklifts, whatever it's going to be. But what I want to do is run through a couple quick things here. So here's a policy where we're doing a $10,000 dump. Chris previously showed you one where it's a $100,000 dump. I'm showing you a $10,000 dump and then 1,000 a month or 12,000 a year. Now this person started the policy when they're 45. And so what we're looking at is, we're going to do that dump in, we're going to do that premium, and I'm not going to run through all the numbers like what Chris was showing, but we have the same thing, cash on cash. You can see the performance of the policy. You can see when it terms cumulative. So by year 7, we put in 94,000. We have over 94,000. So we've broken through that cumulative. And like Nelson Nash would say, how much did this death benefit cost you if you put in 94 and you have 95,000? Well, it cost you nothing. So in this design, we may talk about what are you trying to do with this policy? Oh, I want to put in 10,000 because I had 10,000 and I was thinking of throwing it at my debts. Well, let's run it through the policy, then take it out of the policy and then throw it at your debts. And then we can run that policy through the debt blaster to see what it would actually look like. But there are some different design considerations where what if you wanted to have flexibility where you want to keep putting in 22,000 in years 2, 3, 4, 5, 6, and 7? Could you do that? Well, it really depends on the design. It depends on your income. It depends on your health. There's a lot of things we need to look at. But the exact same policy, let me just show you what that would look like. Now we're putting in the $10,000 dump in for the first, say, 5 years. So why I'm showing this is there's flexibility here. And the first policy I showed you is also the same policy design. It just has the underwriting requirements where we can put in more money. Now, what we're going to do is we're going to go down and look at the premium page, like what Chris was showing earlier. Here's the interesting thing about this design is look at this minimum required, $298 a month, or what is that a year times 12? So let's call it $3,500 a year is the minimum. So now when we do designs, policy designs, wouldn't it be cool if you could have a range of premiums where you could do anything from 3,500 a year all the way up to 22,000? Start thinking about how our banking system works, where we may have years where we want to stuff more in, or some years we need to contract. But in this particular design, because we have a person in a certain season of their life where they want to have this wild, premium range, pretty nice being able to go from 3,500 to 22,000. And again, these are all just design considerations when we're talking to you in our strategy calls. Does it make sense to build it out like this? Is this something you would want to do? Now, here's a question that I have. What could I do in this policy design if I wanted to be able to continue putting that 22,000 in for, let's say, 20 years? So see how it stops after 5 years. I could do it for almost 7 years. But what if I wanted to put this 22,000 in all the way down to year 20? What is something I could do to this policy to make that happen? And this is a test to make sure everyone, oh, David and June come flying in with the answer. Keep the term going. Okay, so David and June, if I do that, if I add a term duration that's not maybe 7 years or 10 years, but maybe it's 20 years, what is that going to do to my policy down here in this? Let's go back down to that page where we're looking at the premiums. So what Dave and June are talking about, instead of a 10-year term rider, we would put a 20-year term rider in, which would allow, remember in that slide I was talking about, it creates more capacity for premium or more mech room. So what's going to happen if I do a 20-year term rider? Can you tell me what's going to happen to this line? More dollars. Felix comes in. So instead of it being $38 per month, it may go up to 50 or 60. So this is where we start to look at, does it make sense to do that? Now let's say that I'm 70 years old and I want to do a $100,000 dump in. What do you think is going to happen to my term cost? Because when I'm doing dump ins, I need really big. Well, when I'm doing dump ins, I'm not really contributing to death benefit, so I need more term to satisfy that mech requirement. So yeah, David and June, you guys are getting the gold star today. If I'm 70 years old and I do a big term rider, it's going to cost a lot. This number is going to get much bigger, this term cost. So part of our design consideration is going to be, does it make sense to do that? Does it make sense to do a big dump in? And we may come back and say, the term cost is just outrageous. It doesn't look like you're going to get much of a benefit if we do a really, really big dump in. So we might say instead of a $100,000 dump in, we could make this work with a 50 or a 40,000. So there's so many different considerations, and I'm just kind of hitting on some of them, but there's so many different considerations in policy design, how we construct these ingredients to make sure that it works for what you're trying to accomplish. And I think that's what we really want to stress in this session is there's not a rubber stamp, everybody gets this kind of a design. It really is custom tailored to everybody's specific needs, how we design that base portion, the PUA portion, how much term we put in, if any at all. So those are some of the things that we need to consider when we're talking with you. If you were to call that 866-329 BYOB number, get on a strategy call. These are the kinds of conversations we're going to have. So Chris, anything you want to add to this, or Stephen, anything you want to add to this?
No, I have a couple takeaways and things that I learned. And number one thing I learned is doing it the way you just showed it on the screen is way more visible than trying the new thing that I did. That's step number one. Step number two is swearing on a webinar will lose a couple people, so don't do that. Tony Robbins can get away with it, but I can't. So that's my second learning lesson. And number three, using the vault makes your life so much easier with the infinite banking concept in your own banking system. Those are my three takeaways.
All right. Yeah, so I think with that, if there's any questions, happy to address those. But otherwise, we can wrap up. But anyone have any questions, anything I've gone over, happy to drill into it in more detail. We threw a lot of information at you, but I would encourage you, I'll put it back up again, to just grab a picture of this design, because this is going to show you all of those different relationships. And when you see a policy design, you can go back and go, wait a minute, this thing has a lot of base and not much PUA. So that means I'm not getting as much cash value. Why did they design it that way? And so you can come back and have a more fruitful conversation on why was something designed this way. And that's really what we want you to understand. And more importantly, we want to get the right policy design so that you can apply it for your debts, for your major purchases, for your opportunity funds, or whatever else you're going to do. So that's our whole goal, is we wanted to be able to get you to the point where these things weren't foreign, the language wasn't foreign, and you would be able to have a good conversation about, hey, I just got a policy design. What does all this stuff mean?
Yeah, and I just put it in there. If any of you want to try the vault out, give it a test for 7 days free. You can do that by just going to BYOB Vault. I put the link up there. David and June, your question, will the vault work well if somebody only has policy loans as debt? Yes, 100%. Because what it'll do is it'll show the economics around those policy loans, around what the money's gone to. Because, it's not just, so I guess a lot of times maybe a fault, that we sometimes get trapped into is we love talking about debt because that's just When you look at the entire United States, our demographic, if you will, there's just a lot more people that have debt than people that don't. But when we find people that don't, in your case, David and June, because when you look at your policy loans, you shouldn't be looking at those policy loans as debt. They should be looked at as assets. Think a bank, right? Bank makes a loan, and that's an asset to the bank. So when you're doing that, when you're borrowing from the insurance company, taking a loan, that money's going somewhere where it's going to earn for you. There's not a bank in the world that lends money out at a loss. Like they sometimes lose money on bad loans, but they lend money out in an effort to make money. They make a spread. So when you take the loans, chances are you use that money to go make more. So the vault will show you the economics. We'll basically put all that into the vault, build your policies in. It'll show all the economics around what it is you're doing. And it'll actually, with the gains projector, allow you to kind of model future investments or future loans and major purchases. You can model everything in there and see what the future outcome would be of your actions, and then make a decision. Oh, does that make sense to do this or not? So the vault is incredibly valuable for far, far more than debt. Oh, that's awesome. David and June will be in Atlanta. Can't wait. Can't wait. We could kind of continue that conversation after that. But Craig, you did a fantastic job. Thank you so much for having that together, because my plan sort of, crashed and burned a little, but that's okay. It was worth a shot. So thanks for backing me up and having this stuff where people could actually see it. So it was pretty darn good. But, I hopefully all of you got a good firsthand look at, number one, why you should be your own bank. Okay, it makes all the sense in the world. There's not one person I think we'd ever come across that should not be their own bank. There are people that we come across that just aren't at that stage in life yet, that season in life where they're ready to become their own bank. Okay, we can help show them the path. And listen, like, the most important thing is, even if you're not ready today to do your own private banking system, set up your own policy, understanding and learning what this is so that you can work toward it will allow you to accomplish that goal much quicker. Earl Nightingale talks about that a lot. He says you need a worthy idea, and you need to work toward that worthy idea and believe in that worthy idea each and every single day. So if somebody can't do this, you still should be studying this. You should still be, looking at this and saying, how would this look in the future when I'm ready? And then you'll get there much quicker. And then for the rest of you, and thank you, Marie, we got your phone number. We'll send you a text to book a call. And if any of you want to get on a call with us, no matter where you're at, we'll meet you where you're at. We'll talk about your situation, your needs, your goals. Just give us your phone number, okay? Just put it over in the, I prefer people to do that in the Q&A. So put your phone number over in the Q&A. We'll send you a message, and then we'll get a call booked up. But with that being said, we gave you the number, the BYOB number. Give us a try, give us a shot. If you're already working with somebody, have us. We just did this. This is really cool, and I'll finish on this, Craig. We were at an event, and we met a couple, really great couple, and they had a really, really good IBC practitioner that they were working with. And we know this person really well. And she pulled the illustration up, and I'm like, okay, this is designed pretty good. But then what Craig did is Craig said, okay, well, let me look at what they designed, and let me run it into the vault to see if this can be maximized. See, can we get more efficiency out of exactly what this really good IBC practitioner designed? And what Craig was able to do is actually make it pretty significantly better. And when we showed what Craig did to the clients are like, we want to do business with you. And I'm like, well, hold on a second. We have a relationship with this other IBC practitioner. How about this? Let me call that IBC practitioner. Let me see if we can work this case together, and then we can do a split. That way we're not stepping on their toes. We're working with them. Everybody wins, and you get exactly what you want. And now, for your benefit, because you like this other IBC practitioner, you could still work with them, but you get all of our resources. You get the vault, you get our advanced services team, you get all the things that we built that they don't have. And that was a win-win. And we love it when that happens. We do that actually more than we probably ever talk about, because we're not out there just trying to take other IBC practitioners' business. We're just trying to do right by the client and give the client the best thing. And if the agent that they're working with is doing a good job, like, we'll just show them how to make it better. Even if that didn't work, where we couldn't split, we would have probably still said, just move forward with them. Just show them this illustration and have them design that. But the other agent was like really excited that we called him, which was kind of surprising, but it was really fun. And was like, I'd love to work this case with you. I think that I could learn some things. And in doing that, he did. He saw ways where he can make his designs more efficient. What we've done that nobody else has is we've created the software, the Vault software, that gives us that big, huge mile, ahead lead over everybody else because we now have the ability to mathematically prove all of it. And, it's going to take a long time for other people to catch up to the software. And by that point, our software will be AI interfaced and plugged into all of our systems and nobody will catch us. But anyway, now I'm just bragging about the vault. All right, folks. Well, I've taken enough of your time. I appreciate it. I do want to end on George's question here. He said, when money is withdrawn from a traditional IRA, is the tax you need to pay on the withdrawal money paid before the withdrawal money comes to you, or is the tax payable later at the time you pay your income taxes in April? This is a really good question. And the answer is whatever way you want. So, and it also depends. Some custodians that hold your money, I think like, I don't want to pick on Fidelity, but I think Fidelity mandates you withhold 20%. So if it's a traditional IRA, we're not talking about Roth, but a traditional IRA, and you take a withdrawal, some custodians will mandate that you withhold a certain federal amount, okay? Other custodians, they don't care. You can just take the money and then you just get you get the tax bill at the end of the year, and then you just file that with your taxes. So George, it depends on what custodian you're with. But just give them a call and ask if you have that option. Because listen, like I get it. Like, why give the government money to hang on to, tax dollars to hang on to, if we can keep it for a couple months and use it, right? Because that's what the government's going to do. They're going to take our tax dollars that they withhold early, like our estimates, and they're just going to go, well, I hate to say use it wisely, but they're basically going to go blow it. And we can do a better job with our own money. So great question, George.
Hey, Chris, just a quick update. The Federal Reserve decided to keep rates steady, so no change. However, it was very, very high levels of dissent, the highest since 1992, with an unusually divided Federal Reserve as policymakers grapple with the challenge of balancing the threats of persistent inflation with a softening labor market. Also coming out of the meeting, Jerome Powell, likely his last meeting as the chair of the Federal Reserve, as he's stepping down in mid-May. But he does plan to remain as the Federal Reserve governor through January of 2028 as of now. So some interesting news coming out of the Federal Reserve.
Well, that is interesting. So I would have thought it would have been a pretty unanimous decision across the board to hold based on what I was reading, but it wasn't. It was decisive or divisive, or what's the word used? Divisive?
Highest levels of dissent since 1992. Divided.
That just shows you right now that there's massive divide even within the Fed, in terms of like where we're at. Where is the economy? I mean, some data says everything's good. Other data says we're about to go off a cliff. So like we need to start cutting rates to kind of stabilize this and keep this economy going. Otherwise, with these oil prices. So there's a lot of things happening right now, folks. We talk about this on our show, WTF. And then we also do another show later today called Ask Me Anything Happy Hour, where we can get deeper into these questions. But very interesting. Thanks for sharing that, Stephen. All right, folks. Well, with that being said, thanks everybody for joining us for this week's episode of Wealth Webinar. We'll see you on the next one.